A tale of two markets Thursday, the Dow hitting a record high, but rising Treasury yields denting the NASDAQ. Let's get a technical view of the markets from our own Terence Gabriel. He is Stocks Buzz analyst at Thomson Reuters. Welcome back and good afternoon, Terence. So it seems to be this ongoing pattern. Rising yields, rising bank stocks and reflationary stocks, but sinking tech stocks. So how much longer can this reflation trade continue to lift the Dow and the S&P 500 before losing momentum?
Well, there's a lot going on in this market right now, Fred. By some measures, we can sort of say this is a fractured market. We have the Dow making record highs, the S&P 500 making record highs. But yes, the NASDAQ sold off more than 10% from its mid-February peak into its March low. And there's been a lot of volatility. The question here is, yes, can that reflation trade continue to hold up while the tech stocks and the NASDAQ sort of flounder? Now, when we look at the charts, we see the Dow actually right here is battling a 92-year resistance line, which is about 33,100 roughly. The S&P 500 also has a 10-year plus resistance line, which is about 4,010. So just where we are now, or just slightly above these levels in these major indexes, there are resistance hurdles that have to be cleared in order for this market to continue moving higher.
And it seems as though a lot of it is contingent on the 10-year Treasury yield, where Treasury yields are. And if that is the case, what do the charts tell you in terms of what direction, how much higher or how fast these yields are headed?
Yes, it's a very important point. When we look at the 10-year Treasury yield, we see that it has actually moved up quite quickly, say over the last month. We've had about a 45 basis point jump in that Treasury yield. And during that time, that's when we saw the NASDAQ sell off more than 10%. So the question here is, what does it look like on the charts now for the Treasury yield? And the trend is still favoring higher yield. So therefore, if we were to see this Treasury yield move, say, over 2%, that could conceivably be a real problem for the overall market as a competition for funds, but also something that could continue to put downward pressure on the high PE growth stocks in the NASDAQ.
And for this market rally to hold, Terence, how essential is it that tech stocks get back into the game, or is it okay for the reflationary trade to just go on and carry the market?
Well, of course, tech is the largest capitalized sector within the U.S. stock market. So it has to do the heavy lifting if the market is going to continue to move up. The problem, again, though, that with rising yields, it can depress the PE multiples in those sort of high octane growth stocks. But also, we have to keep a close eye, for instance, on oil and commodities. We're seeing sort of a 4-week low today on the Thomson Reuters CRB index. Oil's under pressure. Energy stocks suddenly sort of are stumbling, even though we see financials, industrials, and materials making record highs. Energy, of course, peaked a long time ago in 2014, but it's had a very, very strong run since that March 2020 trough. So whether or not this market can keep moving forward sort of will depend on whether that reflation trade can remain intact. If it doesn't, we need to see a rotation back into the growth stocks, but you probably would need to see yields back off a bit in order to sort of fuel that. The other side is then you have to worry about, is the economy recovering or not recovering, and what all these, what that would have in terms of the implications in terms of what the Federal Reserve is going to do with their promises of keeping rates low and policy very accommodative moving forward. So the market might suddenly feel that that situation is changing, and it could change quickly. So it definitely is a time when there's the risk for very high volatility, and one has to sort of be monitoring this market, I think, very closely.
And oil prices, which you alluded to earlier, were down for the 5th straight day. Thanks a lot, Terence, for your analysis.
Thanks, Fred.
Our thanks to Terence Gabriel of Thomson Reuters. I'm Fred Katayama in New York. This is Reuters.